Good morning and welcome to today's webinar from East Capital Group here in Stockholm. My name is Marcus Rågmark and I'm a member of the sales team at East Capital. Over the next 20 or so minutes, we're going to focus in on the global frontier markets landscape and the opportunities we see ahead in this asset class. It's very encouraging, obviously, to see the consistently strong performance that the frontier markets have delivered, not only this year, but also over the longer term, where we're now on track for the third consecutive year of above 20% returns in US dollar terms for the asset class. Nevertheless, these markets remain somewhat off the radar still of many global investors. So today's webinar really is going to aim to dissect what's driving the strong performance, why we think there are still good opportunities ahead and good opportunities for this run to continue, and finally as well to highlight the compelling investment case for global investors. With me for this, I have Emre Akcakmak, our head of frontier markets, who has been responsible for the fund since its inception more than 10 years ago now, in 2014. Welcome, Emre.
Thank you, Marcus.
And just before we start, I would just like to remind our viewers that we have the Q&A function available as well. If you would like to add any specific questions, please do so in the top right-hand corner of your screen. So, Emre, if we just take a couple of minutes to refresh our viewers of the compelling investment case of frontier markets and its key characteristics, what would those be?
So we had a great start with you calling my surname in the right way. And thank you everyone for participating in this call in the wonderful land of frontier markets. Let's remember of frontier markets, first of all, it's not like emerging markets or developed markets. So we always need to make a quick reminder, what are these markets? These are not necessarily big emerging markets. These are not developed markets, but these are not markets that are limited to index providers. So we are capturing the opportunities in essentially next generation emerging markets. So we take some of the smaller emerging markets where you wouldn't get a meaningful exposure to. These include the likes of the Philippines and Egypt having, 20, 30, 40 basis points weight in the indices. And then we take advantage of smaller markets. And the headline of the presentation is the winning streak continuing. Is this going to continue? I think typically when managers talk about their strategies, it's a buy at all times. We don't need to come up with creative ideas to make it a buy. I think we have quite fundamentally strong dynamics driving these markets, and we can change positions. We can go into this huge universe of 20, 25, 30 markets, depending on market circumstances. So we don't need to always defend one side of the equation. But if we are to remember the characteristics, these are fast-growing next-generation emerging markets. When you look at frontier markets, they are growing by 4.3% on average. Emerging markets, on the contrary of frontier markets, are now getting a little bit older, 3.1% average growth, whereas developed markets are posting 1.4% on average. But it's not ending there. I think returns have been good. If you look at a few lines here, it's a pretty crowded table. But if you look at standard deviation, what you're going to notice is that frontier markets are actually less volatile compared to emerging and developed markets. Even compared to developed markets, they are less volatile. This is due to benefits of diversification. Performance has been pretty good, as you mentioned, 3-year rolling 90%, 5-year rolling 110% net of fees for the retail class. This is. And if you look at maximum drawdowns, you're going to notice that frontier markets, both our strategy and frontier markets index, have been posting less drawdowns compared to emerging and developed peers. So it is ticking a lot of boxes. These are the markets that are not represented in majority of indices, mainstream indices, but these are markets providing investors with growth, diversification, low volatility, and attractive valuations.
Thanks, Emre. I think you summarized it very well there in a short period of time, of course. But again, I stress this lower volatility as a very important aspect, of course, together with the strong returns that the asset class can deliver, giving a very strong picture on a risk-adjusted returns basis as well. Global equity markets have seen remarkable strength this year, as we all know, driven largely by AI-driven gains in developed as well as larger emerging markets. So against that backdrop, frontier markets have also managed to deliver consistently strong returns. If we sort of scratch on the surface, what has actually been driving this performance, Emre?
Economies are maybe there is no AI. You can't expect these younger markets to produce chips, semiconductors, or any other very high level of technology materials, unfortunately, at this stage in time. But these markets are also seeing quite positive dynamics in their economies. There are a lot of myths about frontier markets. Number one is always inflation, apart from growth, of course, and currencies. So when we look at these markets from this angle, inflation is very well behaved in majority of frontier markets. You have a few of them, including Egypt, Nigeria, and Turkey, seeing higher inflation. But when you look at majority of our strategy, inflation is pretty close to the US and EU. You have below 5% inflation in approximately 60-70% of the markets that we invest in. So that is one thing to remember. Another point that's happening now is that inflation is low and it's getting lower. Whereas central bank rates have been pretty high over the last few years. Right after COVID, we had central banks tightening. But now it's not only about the Fed or EU, it's about all emerging and frontier markets. They are all cutting the rates. When you look at this list, it's so many markets here, but what you're going to notice is that it's only one market which hiked its policy rate over the last 3 months. It's Kazakhstan. Apart from that, Brazil, the latest move was a hike, but now they are waiting for the inflation to stabilize for the next move, and next move will likely be a rate cut. When you look at real rates, you have pretty high real rates defending the currencies. So what I'm trying to say is that it's central banks are in a deep rate cut cycle. These rate cuts will continue. This is supporting the markets. It is also lowering the cost of borrowing, cost of equity, helping equity markets as well. So you have these positive underlying dynamics. And as the following leg of these rate cuts, of course, growth should be accelerating. Growth is already accelerating. Economies are already stabilizing, but it's a pretty helpful positive cycle for these markets. When you look at the global picture, financial conditions are easing in the US. I had to double check these figures, but if you look at US financial conditions index, except for this brief period of COVID, when financial conditions were easing very quickly, this is the best times for US financial conditions. And it's not a coincidence that S&P is now every day is a new all-time high. But when you look at emerging and frontier markets, bond spreads are as tight as it gets. So since 2007, these are the best times from a risk appetite perspective, both for emerging and frontier markets. And the other angle of discussion when it comes to how economies are doing, how stock markets are doing, we have the currencies headwinds turning into tailwinds. This is our classification. Maybe we don't need to go too much into details, but majority of our currencies are pegged or having euro or EU anchored currencies. Only about 9% of our currencies are inherently less stable. But if you look at the also last 3 months changes, currencies aren't moving anywhere. Nigerian naira is even appreciating, and 1 year is also pretty stable. So I think the name of the game is recovery and stability. So it's not a coincidence that these markets have been rallying over the last 2-3 years.
Great, Emre. So several tailwinds ranging from the stable currency situation to supportive monetary policy as well across almost all of the frontier markets, you can say. Looking at the frontier universe and the breakdown by country, Vietnam being the largest constituent has been on an extremely strong run this year and the standout performer really of the universe. So what's your view on Vietnam now moving forward?
Vietnam, and let's take a few other markets here as well. So Vietnam growth is accelerating. If you focus a little bit to the end of this chart, quarterly GDP growth, Vietnamese growth was slowing down post-COVID, down to 3, 4, 5%. I said slowing down to 3, 4, 5 because Vietnamese economy had been growing by 7% pre-COVID in a very consistent manner. And starting from last year, we saw growth getting back above 7%. And this year, we are even talking about 8% for the first quarter, 8% second quarter, and 8.2% for the third quarter. So growth is actually accelerating in Vietnam. As a partial reflection of that, we saw main index rallying this year to all-time highs. But not only that, equity market activity turnover has been growing from 100 to 200 million, 300 million. And nowadays, we are talking about $1 billion of equity turnover. So this has been the main driver of performance for Frontier Markets Index. It's a very positive cycle. Companies are growing, earnings are growing, economy is growing, but there's also growing interest in the equity market. But not all markets are having similar dynamics. In Nigeria, for instance, you have the early cycle economic recovery starting. Policy rate is coming down or to come down, inflation is coming down, and growth in Nigerian standards, 4% is nothing because before oil prices took a permanent decline back in 2014, 2015, Nigeria was growing by 6%. Now it's getting back to 4%, but going forward, I think growth will be quite strong as inflation is easing and policy rates are being cut. Another different market, and again, one question requires many different answers. Very quickly on the UAE, which is where I'm based in, non-oil GDP is growing by 7% since 2021. This is massive GDP growth for a relatively sophisticated market because non-oil economy is growing, share of non-oil is growing. You have plenty of opportunities. But I wanted to point out that not all markets are doing greatly. In Saudi Arabia, low oil prices are putting a lot of pressure on budget dynamics. Oil break-even price is 90, and that market is not performing as well as others. But what I'm trying to say here is that you have so many different cycles that we can take advantage of that. We don't have to invest in all these markets at once. We don't track the index that closely. We have 86% active share. So we are investing where opportunities are.
Thanks, Emre. And I think that's an important point that you finished with as well, that you are very much agnostic when it comes to your country allocation, in contrast to our other global fund, the Global Emerging Markets Sustainable Fund, which of course is country neutral in terms of its country allocation. So on that topic, how are you and the team looking to invest in the current environment that we see? And can we remind viewers of the key characteristics of our particular frontier market strategy as well?
Well, this is how we invest. We need to be on the ground, traveling all the time to different parts of the world. But if we are to maybe just try to understand the main characteristics of how we invest, we travel a lot. We look for opportunities. We don't have to invest in every stock, every market. We can exit a market and come back 3 years after or 5 years after. So we are quite flexible in our approach. And the main theme in our investment is under penetration, growth opportunities, new markets. So when you look at retail markets, you have modern food retail, for instance, coming from a very low base from unorganized markets to organized ones. Financial inclusion is another theme, how we invest, broadband penetration. So these are all quite long-term structural growth stories that we are investing. And when we look at and take all the pieces together to have a look at our strategy, we have total of 36 holdings in 17 markets. That tells you the story We don't have to invest everywhere. We don't need to invest in 5, 6, 7 stocks in every market. We just need to cherry pick in these markets. And in fact, we are investing in 2 stocks in every market on average. 86% active share. Majority of these shares that we invest in are off index. When you look at the portfolio, it's a pretty well balanced portfolio of holdings. A little bit deeper into fund characteristics, this might change in a month's time or in 3 months' time, depending on market developments. But it's a pretty well balanced from a country perspective. I think one angle to add to the discussion is how are we doing in country and sector weights? You have many different teams. We have a lot of financials nowadays. We are investing in banks at 2, 3, 4 times PE. But this is also quite well diversified in Egypt, Slovenia. Then you have UAE real estate based on the current real estate boom. In Vietnam, we have consumer. So it's a pretty well balanced and well diversified strategy, which has been delivering also good returns looking at the financials. So you have quite positive tailwinds. We have our Magnificent 17 compared to Magnificent 7. Quite strong performance, as mentioned in the beginning of this call, when looking at the financial sector. Not only that, non-financial sector is also doing fine. And this is how we have been able to generate these decent returns over the past few years.
Thanks, Emre. And thank you also for highlighting the Magnificent 17. That's a new term. And obviously, we'll work hard to make this more mainstream as well in the media rather than only Mag 7. So thanks for that. The consistent, double-digit earnings growth on offer in frontier markets is clearly another very appealing characteristic of the asset class. And this is also, of course, one of the reasons why valuations are still very attractive despite the strong run that we've seen. So can you just elaborate on the importance of this strong earnings growth that we're seeing, and do you see it lasting going forward?
Yeah, it doesn't end with valuations. Of course, valuations are now quite outstanding from a historical perspective and in relative terms, but you need to have a bit of earnings momentum as well. It is how we conceptualize earnings growth. We can't put our finger to say these markets will always grow at 12%, 15%, 20%. But how we think about earnings growth is starting with this economic growth that we talked about. So what we say and what we said in the beginning of the strategy, that was 10 years ago, 11 years ago, was also that you have nominal GDP growth, 3 to 6%. Sorry, real GDP growth, 3 to 6%. There's an error there. Starts with real GDP growth. On top of that, you have inflation, 3 to 6% inflation, let's say, to be on the conservative side. So you get a nominal GDP growth of 7, 8%. And if we are able to pick the right sector and right stock, we thought we would be reaching 15% nominal earnings growth every year. And this has been the case for over the last 10 years on average. And in terms of returns for investors investing in US dollar or euro terms, you have the base growth, and then you have equity re-rating or de-rating, and then dividend yield, buyback yield from companies. And in the end, these currencies, of course, this is all in local currencies so far, plus minus, let's call it that way. So far, we have been losing out on the currency. Despite this strong performance, currencies have been depreciating. But next few years, we don't expect any major depreciations anymore. And that will be translating into equity returns, all these components combined. And on the valuations, coming back to your point, this is how it looks. Frontier markets for our strategy are trading at 6.6 times earnings for the next 12 months. You still have decent earnings growth. You still have low valuations. And compared to developed and emerging markets, of course, it has to be at a discount. We are not saying that frontier markets should be coming at a premium. But this is both in absolute terms and in relative terms relative to other peers, close to all-time high levels and all-time attractive levels, despite the strong performance over the last few years.
Very good. And that paints indeed a compelling picture, as you say, and also provides a good degree of downside protection. If we look ahead then into 2026, are there any key themes or markets that you would like to highlight, and where do you and the team basically find the best value now moving forward?
I think just because it's 31st of December to 1st of January, I don't think things will be changing so much. What we see is that for global markets or for emerging markets in general, when you look at global financial conditions, spreads, risk appetite is there. Frontier markets are either in a recovery mode or they are continuing with their growth. Company earnings are growing, politics are more stable compared to last few years. Currencies are stable. US dollar strength is, I can't call that it's over, but US dollar isn't strengthening anymore. Maybe it will even soften going forward along with Fed rate hikes. So overall, you still have a favorable environment for these smaller emerging and frontier markets, and take into account of valuations which are at a deeper discount. Let's say in a negative scenario, we would expect a less drawdown or downside protection for these markets. And in a continued positive environment, we would expect further re-rating, and that's coming along with earnings growth in frontier markets. So I think despite the strong performance, it's still a favorable environment in 2026.
Thank you, Emre. And I think with that optimistic tone, we'll end there. Thank you to all of our listeners as well for dialing in today. And I hope we've managed to give you a good picture of the frontier markets landscape and where we are today, as well as the outlook moving forward. As always, we're more than happy to set up individual one-on-one meetings with Emre as well, should you wish to explore this topic any further. So with that, thanks again, and hope to see you soon.